The Tulip Mania, 1637. Background. During the Dutch Golden Age, tulip bulbs became a highly sought-after commodity, with prices skyrocketing to extraordinary levels. Speculation in tulip bulbs reached fever pitch, fueled by a frenzy of buying and selling. The speculative bubble was driven by a combination of factors, including a novelty appeal of tulips, limited supply, and the introduction of futures contracts allowing traders to buy bulbs at preset prices. Impact. The bubble eventually burst in February 1637, leading to a sudden collapse in tulip prices. Many investors were left financially ruined as the market for tulip bulbs evaporated almost overnight. Legacy. The Tulip Mania serves as a cautionary tale about the dangers of speculative bubbles and irrational exuberance in financial markets. The South Sea Bubble, 1720. Background. The South Sea Company was granted a monopoly on trade with South America, leading to a surge in its stock price. Investors speculated heavily on the company's shares, driving prices to unsustainable levels. Cause. The South Sea Bubble was fueled by investor speculation and fraudulent activities, including false promises of lucrative returns and government corruption. Impact. The bubble burst in September 1720, causing a financial panic and widespread losses for investors. The British government intervened to stabilize the economy, but the crisis led to a loss of confidence in financial markets. Legacy. The South Sea Bubble exposed flaws in financial regulation and governance, leading to reforms aimed at preventing future speculative bubbles. The Panic of 1837. Background. The United States experienced rapid economic expansion in the 1830s, fueled by speculation in land, infrastructure projects, and banking. Cause. The Panic of 1837 was triggered by a combination of factors, including the bursting of speculative bubbles, a contraction of credit, and the failure of state-chartered banks. Impact. The crisis led to widespread bank failures, business bankruptcies, and unemployment. The U.S. economy entered a severe recession, with significant declines in GDP and trade. Legacy. The Panic of 1837 highlighted the dangers of speculative excesses and the need for financial regulation and stability in a rapidly growing economy. The Great Depression, 1929 to 1939. Background. The Great Depression was the most severe economic downturn in modern history, triggered by the Wall Street crash of 1929 and exacerbated by a range of factors, including bank failures, deflation, and protectionist trade policies. Cause. The Depression was caused by a combination of structural weaknesses in the global economy, financial instability, and policy mistakes, including the Smoot-Hawley Tariff Act and restrictive monetary policies. Impact. The Depression led to widespread unemployment, poverty, and social unrest, with significant declines in industrial production, international trade, and investment. Legacy. The Great Depression spurred major reforms in economic policy, including the New Deal in the United States and the establishment of international institutions such as the IMF and World Bank. The Asian Financial Crisis, 1997-1998. Background. The Asian financial crisis began with the devaluation of the Thai baht in July 1997, triggering a wave of currency collapses and financial contagion across East Asia. Cause. The crisis was caused by a combination of factors, including excessive borrowing, currency pegs, and speculative attacks on weak financial systems. Weak regulation and crony capitalism also played a role. Impact. The crisis led to severe economic recessions in countries such as Thailand, Indonesia, South Korea, and Malaysia, with widespread bankruptcies, unemployment, and social unrest. Legacy. The Asian financial crisis highlighted the vulnerabilities of emerging market economies and led to reforms aimed at strengthening financial regulation, corporate governance, and crisis management. The dot-com bubble burst, 2000. Background. The dot-com bubble was fueled by the rapid growth of internet-related companies and speculation in technology stocks during the late 1990s. Cause. The bubble was driven by investor enthusiasm for internet startups, many of which had high valuations despite little or no profits. Excessive speculation and overvaluation contributed to the bubble's collapse. Impact. The burst of the dot-com bubble led to steep declines in the stock market, widespread bankruptcies among tech companies, and significant losses for investors. Legacy. The dot-com bubble burst exposed the risks of investing in speculative markets and prompted a reassessment of valuation metrics and investment strategies in the technology sector. The global financial crisis, 2007-2008. Background. The global financial crisis began with the subprime mortgage crisis in the United States, characterized by the collapse of the housing market and the failure of major financial institutions such as Lehman Brothers. Cause. The crisis was caused by a combination of factors, including lax lending standards, complex financial products, excessive risk-taking by banks, and regulatory failures. Impact. The crisis led to a severe recession, financial market turmoil, and government interventions to stabilize banks and stimulate economic recovery. The effects of the crisis were felt globally, with significant impacts on employment, housing, and public finances. Legacy. The global financial crisis prompted major reforms in financial regulation, including the Dodd-Frank Act in the United States and increased oversight of banks and financial markets globally, the European sovereign debt crisis, 2010-2012. Background. The European sovereign debt crisis began with concerns over high government debt levels and fiscal sustainability in countries such as Greece, Ireland, Portugal, Spain, and Italy. Cause. The crisis was triggered by a combination of factors, including weak economic fundamentals, unsustainable borrowing, banking sector weaknesses, and the lack of a unified fiscal and monetary policy framework in the Eurozone. Impact. The crisis led to sovereign debt defaults, bank bailouts, austerity measures, and economic recessions in affected countries. It also raised questions about the future of the Eurozone and the viability of the European Union. Legacy. The European sovereign debt crisis prompted reforms aimed at strengthening fiscal discipline, financial regulation, and economic governance within the Eurozone, including the establishment of bailout mechanisms and fiscal rules. The COVID-19 pandemic recession, 2020. Background. The COVID-19 pandemic recession was triggered by the global spread of the COVID-19 virus and the resulting public health measures, including lockdowns, travel restrictions, and business closures. Cause. The recession was caused by the disruption of economic activity and supply chains, reduced consumer spending, and financial market volatility resulting from the pandemic and efforts to contain it. Impact. The recession led to steep declines in GDP, employment, and business activity, with significant impacts on industries such as travel, hospitality, and retail. Governments implemented stimulus measures and monetary policies to support households and businesses during the crisis. Legacy. The COVID-19 pandemic recession highlighted the interconnectedness of the global economy and underscored the importance of preparedness, resilience, and coordination in responding to future crises. What other economic crises would you add to this list? Let me know in the comments below. By the way, please show some love by hitting the like and subscribe button, and I'll see you in the next video.